There was a time early in my career when I tried to trade my way out of losses by thinking harder, not by reading price more clearly. I added indicators, widened stops, and forced trades, only deepening the drawdown. The market taught me a costly lesson: losses are not recovered by effort, but by alignment. Recovery begins when you strip the chart bare and let price itself tell you when you deserve to trade again. 5 keynotes, entire speech. Here are 5 clear keynotes for the entire speech, written from a professional price action trader's point of view in the Wyckoff style tone. Keynote 15. Losses are information, not damage. Every trading loss is a message from price, not a personal failure. The professional does not rush to recover money. He studies why price behaved differently than expected. When losses cluster, it is often the trader, not the market, who is out of sync. Recovery begins the moment you stop fighting the loss and start extracting its lesson from raw price behavior. Keynote 20. Stop trading first. Read price again. The fastest way to deepen losses is to keep trading while emotionally involved. The professional steps aside and observes price with no position at risk. Structure, effort versus result, and the quality of reactions reveal whether the market is ready to reward participation again. You do not recover by trading more. You recover by waiting for price to invite you back. Keynote 3. Price action reveals when pressure is exhausted. Losses often occur when supply or demand is underestimated. Pure price action exposes this truth. Narrowing spreads, reduced follow-through, and failed pushes tell you pressure is weakening. When price stops making progress despite effort, the market is transitioning. This is where recovery setups are born, not at emotional lows, but at structural turning points. Keynote 40. Recover in stages, not in one trade. Professionals never attempt to reclaim losses in a single move. They scale back size and expectations, allowing price to confirm alignment. Small, well-timed trades rebuild confidence and capital simultaneously. The goal is not to win back money, but to restore correct judgment. Capital recovery is a byproduct of discipline, not its objective. Keynote 50. Let price decide when you're back in control. True recovery is complete only when price begins to behave as anticipated again. Clean reactions, smooth advances, limited adverse movement. When trades no longer require hope, but simply execution, control has returned. The market never cares about your losses. It only responds to correct reading of price. Those who listen recover. Those who force disappear. The average trader treats a loss as an injury, something that must be repaired quickly, preferably by the very next trade. The professional understands something entirely different. A loss is not damage, it is information. It is the market's way of revealing that your read of price was incomplete, mistimed, or misaligned with the prevailing force. When approached correctly, losses become tuition paid directly to the only teacher that matters, price itself. Markets move by cause and effect. Price does not rise or fall at random, nor does it punish individuals. It responds to pressure, effort, and the willingness of opposing forces to absorb or resist that effort. When you incur a loss, it is because price did something you did not anticipate or continued doing something you assumed was finished. That is not a failure of intelligence, it is a failure of observation. The mistake lies not in losing, but in ignoring what the loss is pointing to. Most traders respond to losses by altering tools instead of understanding conditions. They add indicators, widen stops, or change strategies, attempting to correct the outcome rather than the cause. This behavior compounds the error. A loss does not demand more complexity, it demands clearer reading of price. Strip the chart of opinions and focus on what price is actually doing: the spread of bars, the ease or difficulty of movement, the quality of rallies and reactions. These are facts. Everything else is interpretation. Clusters of losses are especially instructive. They often appear when the trader is attempting to impose expectations on the market instead of accepting the market's current character. Trending conditions punish range tactics Ranging conditions punish trend following impatience. Price will always expose this mismatch quietly at first, then expensively if ignored. The professional does not argue. He steps back and asks a simple question: what condition is price demonstrating right now? Losses also reveal emotional involvement. When judgment becomes blurred, trades become reactive. Entries are late, exits are hopeful, and risk expands under pressure. These behaviors do not arise from the market, they arise from the trader. A loss, properly read, shines a light on this shift. It signals the need to reduce activity, not increase it. Recovery begins with restraint. There is no urgency in correcting a loss. The market will be here tomorrow. Capital preserved through patience is far more valuable than capital regained through force. By observing price without participation, the trader regains objectivity. He sees whether movements are labored or effortless, whether advances attract follow, through or meet immediate opposition. This observation restores alignment between trader and market. In time, price will offer clarity again. When it does, the trader returns, not to recover money, but to execute correctly. Profits then follow naturally. Those who treat losses as damage rush and repeat them. Those who treat losses as information evolve. And in markets, evolution, not effort, determines survival. When losses appear, the instinct of the untrained mind is to act, to trade more, to recover faster. This impulse is precisely what separates the amateur from the professional. The experienced operator understands that activity is not progress. In periods of loss, the most profitable decision is often the decision to stop trading altogether. Not as an admission of defeat, but as a deliberate act of discipline. Markets operate in phases. There are periods when price moves freely and rewards correct positioning, and there are periods when movement is uncertain, overlapping, and deceptive. Losses most often occur when a trader continues to apply yesterday's tactics to today's conditions. Price may still be moving, but it is no longer moving cleanly. Advances lack follow-through, reactions cut deeper than expected, and effort produces little result. These are warnings. Ignoring them and continuing to trade is not courage, it is blindness. Stepping aside removes the greatest source of distortion, emotional capital at risk. When no position is open, price can be observed without urgency. The trader begins to see structure again, where price hesitates, where it accelerates, where effort increases without progress. These observations are impossible when the mind is occupied with profit and loss. The market does not change because you stop trading, your ability to read it improves. During this pause, the professional studies price as if it were a new market entirely. He asks, is price trending with ease, or is it overlapping and resisting progress? Do reactions respect prior support, or do they slice through it without effort? Are rallies being met with immediate supply, or are they being absorbed quietly? Each bar contributes to a narrative. The trader's task is not to predict the ending, but to understand the current chapter. Many losses can be traced to premature participation. Entering before pressure is resolved, before structure is complete, before the opposing force has revealed its weakness. When trading is paused, these premature impulses subside. Patience returns. The trader waits not for confirmation from indicators, but for confirmation from price behavior itself, clean breaks, shallow reactions, and movement that no longer requires persuasion. This waiting period is not inactivity, it is preparation. It rebuilds judgment. It recalibrates expectations. Most importantly, it restores respect for risk. When trading resumes, size is reduced, not because confidence is low, but because clarity is being tested. Small positions confirm alignment. If price behaves as anticipated, participation can increase. If not, withdrawal is immediate and unemotional. The greatest error a trader can make after losses is believing that recovery must be immediate. Markets do not reward urgency, they reward correctness. By stopping first and reading price anew, the trader aligns himself once more with the dominant force. He trades again not because he needs to, but because price has made its intention plain. Those who cannot stop trading rarely last. Those who can step aside, observe and wait, eventually trade only when conditions are right. And when conditions are right, recovery is not forced. It unfolds naturally, one correct decision at a time. Every sustained move in the market is driven by pressure. Advances persist because demand overwhelms supply. Declines continue because supply dominates demand. These forces do not vanish suddenly. They weaken, distribute, absorb, and exhaust themselves over time. The trader who understands this does not attempt to call the end of a move. He waits for price action to reveal that pressure is no longer effective. This distinction is critical, especially after a period of losses. Most losing trades are initiated while pressure is still active. The trader believes a move is overextended, yet price continues in the same direction with ease. This is not misfortune, it is misreading effort versus result. As long as price advances with wide spread, strong closes and little retracement, demand remains in control. Fighting that condition is costly. Recovery begins when you stop opposing strength and start identifying when strength fails to produce results. Pressure exhaustion shows itself subtly at first. Price may push to a new high or low, but the effort required increases while progress diminishes. Bars widen, volume expands, yet follow-through is poor. Rallies stall quickly, declines fail to accelerate. This is not reversal, it is hesitation. The professional observes without anticipation. He understands that markets transition before they turn. A key signal of weakening pressure is the character of reactions. In a healthy advance, reactions are brief, shallow, and quickly met with renewed demand. When pressure begins to fade, reactions deepen and become more complex. Price revisits prior areas of activity. Support is tested, not decisively broken. These tests are purposeful. They are not invitations to trade aggressively, but evidence-gathering events. Equally important is the failure of effort. When price makes a strong attempt in one direction and is met with immediate opposition, something has changed. The dominant force is encountering resistance. This does not mean the opposite force has taken control, only that control is being contested. The impatient trader interprets this as opportunity. The professional interprets it as caution. After losses, the temptation is to act at the first sign of relief. A small rally after a decline feels like redemption. But recovery trades entered before pressure is fully resolved are often returned to the market. True opportunities appear when price demonstrates acceptance at a new level, when selling no longer pushes price lower or buying no longer lifts it higher. This acceptance is visible in narrowing spreads, overlapping bars, and reduced progress despite effort. Only when pressure has clearly exhausted itself does price become receptive to a change in direction. At that point, movement in the new direction occurs with less effort and greater ease. This ease is the trader's confirmation. Trades taken here do not require hope or defense. Risk is naturally contained because price no longer wants to move against the position. The market always signals when pressure is spent. It does so quietly, through structure and behavior, not headlines or indicators. Those who listen recover steadily. Those who anticipate recover briefly, if at all. In trading, patience is not passive. It is the active study of pressure and the discipline to wait until it has nothing left to give. The greatest danger after a period of losses is not the market. It is the trader's desire for immediate restitution. The belief that a single trade can repair damage invites excess risk and careless judgment. Professionals understand a simple truth: markets do not reward desperation. Recovery is a process, not an event, and it unfolds through a series of correct decisions, not one decisive act. Losses distort perception. After a drawdown, the trader often seeks certainty where none exists, interpreting ordinary price movement as opportunity. This leads to oversized positions, narrow patience, and wide expectations. Such behavior shifts the trader from observer to gambler. The market, indifferent to intentions, responds accordingly. Recovery attempted in one trade is rarely recovery at all. It is a wager. The disciplined trader approaches recovery as a gradual realignment with price. The first objective is not profit, but confirmation. Position size is reduced intentionally. Targets are modest. The question being asked is not, how much can I make? But is my read of price once again correct? This mindset restores balance. Small gains, when earned correctly, are far more valuable than large gains won recklessly. Price action itself supports this staged approach. After a period of decline or erratic movement, markets rarely transition directly into sustained trends. They test, hesitate, and revisit areas of prior activity. Participation during these phases should reflect uncertainty. The professional trades lightly, accepting that clarity develops over time. He does not force conviction where price has not yet provided it. Each successful trade during recovery serves a specific purpose. It confirms timing, it confirms structure, it confirms emotional control. Losses during this phase are not chased, they are accepted quickly and without escalation. This containment of risk is essential. Recovery capital is fragile, and it must be protected until alignment is proven. As price behavior improves, cleaner advances, shallower reactions, greater ease of movement, the trader responds incrementally. Size increases only after evidence accumulates. This progression mirrors the market's own behavior. Commitment increases as uncertainty diminishes. There is no rush. The professional allows price to earn his confidence. Many traders mistake patience for passivity. In truth, staged recovery requires constant observation and restraint. It demands that the trader resist the urge to make it all back, and instead focus on making each decision correct in isolation. The cumulative effect of these decisions is powerful. Confidence rebuilds naturally, without bravado. Capital grows as a consequence, not a goal. The market does not offer shortcuts. Attempts to accelerate recovery usually lead back to loss. Those who survive understand that consistency is restored the same way it was lost, one trade at a time. By recovering in stages, the trader aligns himself with the rhythm of price rather than imposing his own. In the end, recovery is not about reclaiming money, it is about reclaiming discipline. When discipline returns, profits follow. When discipline is sacrificed for speed, the market exacts its toll without hesitation. The final stage of recovery is not marked by profit, but by control. Control is restored not when a trader feels confident, but when price begins to respond consistently to correct judgment. Many mistake a profitable trade for recovery. Professionals know better. True recovery is confirmed only when price behaves as anticipated over a series of well-executed decisions. Until then, restraint remains the primary virtue. Markets do not acknowledge intentions, opinions, or past experience. They respond only to pressure and participation. When a trader has been out of sync, price resists him at every turn. Entries are met with immediate adverse movement. Rallies stall and exits feel rushed. These are not coincidences. They are signals that control has not yet returned. The solution is not adjustment of tactics, but submission to evidence. Price decides when alignment has been restored. This decision is visible in subtle but unmistakable ways. Reactions become orderly rather than violent. Advances develop with ease, requiring little effort to progress. Support and resistance behave as expected, holding when they should and yielding when pressure is sufficient. Trades no longer feel like arguments with the market. They feel like participation in something already underway. At this stage, the trader's role shifts from defense to execution. Stops are respected by structure, not hope. Targets are reached through natural follow-through, not sudden bursts of volatility. Importantly, the trader is no longer emotionally invested in being right. He is invested in remaining aligned. This emotional neutrality is the clearest sign that control has returned. One of the most dangerous moments in trading is early success after losses. A single winning trade can create the illusion of recovery, leading to premature expansion of risk. The professional resists this impulse. He waits for consistency, not confirmation. Several trades executed correctly across similar conditions must precede any increase in commitment. Price must prove reliability before trust is restored. As alignment strengthens, participation can expand gradually. Position size increases only when price continues to respect structure and timing. If price hesitates, size contracts again without frustration. Control is maintained not by dominance, but by adaptability. The trader follows price, never the other way around. Eventually, there is a noticeable shift. Trades require less monitoring. Decisions are made calmly and executed without urgency. Losses, when they occur, are small and quickly contained. Wins develop naturally. This is not luck. It is the result of patience exercised through the entire recovery process. The market never announces that you are back in control. It demonstrates it quietly through behavior that rewards correct observation. Those who wait for this demonstration survive. Those who declare control prematurely are reminded, often harshly, that the market grants authority only to those who listen. In trading, mastery is not asserted. It is granted by price. Make conclusion of entire speech. Trading losses do not demand retaliation, they demand understanding. Throughout this discussion, one truth stands firm: the market never withholds recovery. It only withholds it from those who attempt to force it. Losses are not a signal to act more aggressively, but to observe more carefully. They mark a moment of misalignment, not a verdict on ability. Recovery begins when trading stops and observation resumes. By stepping aside, the trader regains objectivity and allows price to reveal its true condition. Pressure is studied, not assumed. Exhaustion is identified through behavior, not hope. When the market transitions, it does so quietly, rewarding those who waited for evidence rather than anticipation. Progress returns in stages. Size is reduced, expectations are restrained, and each trade serves to confirm alignment rather than repair damage. Confidence rebuilds as a consequence of correctness, not courage. Eventually, price responds cleanly again. Trades unfold with ease. Risk remains controlled. At that point, recovery is no longer an effort, it is simply the natural result of disciplined participation. The market does not care about past losses, and neither should the professional. It offers opportunity only in the present moment to those willing to listen. When price is respected, control returns, and when control returns, profits follow quietly, consistently, and without struggle.